You're muted right now.
Oh, thank you. Hello, everyone. Thank you guys for joining tonight. We are a little bit delayed. There were some technical difficulties, but super excited to bring this information to you all this evening. Our special guest, Jordan Sterling, is here. So we're not going to delay any further. We're going to let people kind of come in as they may. And this meeting is being recorded. So I typically send it out afterwards just in case there's anything that you missed. But feel free to take notes. Jordan is a wealth of knowledge, and I try to do my monthly Wednesday webinars based on information that I realize a lot of people, especially in our community, don't have a lot of access to. And so Jordan is actually one of my mentor realtors' sons, and he did a phenomenal presentation a few months ago in our office. And even myself included, I'm not very well versed on stocks. And I hear a lot of people asking me about stocks, asking about different methods of investing because my passion is generational wealth. And I know that stocks is one of the ways to build generational wealth. So thank y'all for being here. And I'm going to go ahead and let Jordan introduce himself. I normally have my slides pulled up, but the agenda for tonight is going to just be Jordan's going to introduce himself, and then I'm going to do a raffle, and then he's going to kind of give his spiel, and I'll be asking some questions. And you guys can interact with us. Feel free to be sure to put your questions in the comments if you guys have questions throughout, but we will have a Q&A at the end if you all want to ask questions at the end as well. Okay, Jordan, it is on you. And I'll go ahead and make you the host so you can share your slides.
Okay, thank you. Good afternoon, everyone. Good evening. My name is Jordan Sterling, and I'll go ahead and start sharing right now so I don't forget later. It says sharing isn't turned on.
Okay, you should be able to now. I just made you the host.
Okay. So yeah, good evening, everyone. Can y'all see my screen? You can see it? Okay, yeah, my name is Jordan
Yes.
Sterling. I'm the author of Stocks Aren't Scary. I'm very passionate about investing in the stock market and also creating generational wealth, as Kyera has mentioned. Um, and I started right when I got out of college, and I've realized that there is a huge gap in our community when it comes to investing. And there's just a lot of misconceptions out there. We're in a social media time now where anyone could put information out there. And I just wanted to clear some of that up. So that's kind of why I wrote the book and just explain to people how easy it is to invest in the stock market and what you're missing out on when you're not by not investing in the stock market. Let's see. Oh. So one thing I wanted to start off with is the rule of 72, and I'll be quick with this. But basically, this rule kind of highlights compound interest, and basically, if you divide 72 by your rate of return or by your interest rate, that's usually how long it takes for your money to double. So as you can see, we have an example right here that if you start with $10,000 at a 3% return, so you'll divide 72 by 3. That's how long it'll take your money to double. So as we see with the 3% return, if you have your money in a vehicle that's giving you 3%, that $10,000, it'll take about 24 years for it to double because you divide 72 by 3, and that's how long, and you get 24. So that's how long it'll take that's how many years it'll take your money to double. And then in 48 years, your $10,000 will be about $40,000, which isn't bad. And then you can also see the same for the 6%, right? Same $10,000 doubles in half the time. So 12 years, because you divide 72 by 6 and it takes, you divide 72 by 6 and it takes 12 years for your money to double. Does that make sense? Is everyone following me? I don't know if they're allowed to talk. Yep. And then we'll do the same thing for the 12% return. You take your $10,000, you take 72 divided by 10,000. I mean, take 72 and divide it by that 12% return, and your money doubles in 6 years. So a lot of people, these rate of returns actually represent something. So the 3% return is actually what the good banks are giving you. So the credit unions, high yield savings accounts, they're giving you 3% returns. So if your money, and we're using an example, $10,000, if your $10,000 sits in a bank account and get a 3% annual return in 48 years, that's how much money you'll have. You'll have about $40,000. So somebody with that same $10,000 that gets a 12% return instead of a 3% return, and 12% return is kind of what the market is giving. The market gives between 8 and 12% annually. That same person with that same $10,000 invested, so same job, same background that you have, same occupation, working just as hard, they put their money in a vehicle that gets 12% returns. In 48 years, they'll have $2.56 million. And then they pass that down to their generation, they do it again. And then they pass it down to their generation, they do it again. And that's how generational wealth is created. And that's how the wealth gap becomes so large. So I really like to highlight that just to show you what you're missing out on if you're not investing in the stock market. A lot of people that look like us, we have our money in this 3% vehicle. And when we pass away after the funeral costs, our generation, the next generation is starting over from zero. They're continuing to build in that 12% vehicle. So next slide I wanted to show real quick is this is the S&P 500. This is basically the chart of the S&P 500. So this is the 500 best companies in the US. And this is the overall market in the last 30 years. And as you can see, we've had recessions, we've had crashes. It seems like people think we're always in a recession. The market's always about to crash. But if you look over the last 30 years, the market has always gone up. History tells us the market always goes higher. So being in the market, time in the market is your friend. So obviously we wish that we can started investing 30 years ago, how much money we'd have now. But let's just talk about the last 5 years. If you started today, May 27th, 2020 and 2021, so May 27th, 2021, 5 years ago, exactly 5 years ago from today, if you start investing in the S&P 500 index, you'll be up 78%. So that $10,000 that you started with would be about 17,780 something bucks. Just sitting no bank is giving you that. So just sitting in the market instead of sitting in the bank, you have a $7,000 return. And this is just in the past 5 years. So we all could have done this. And this is just an example. This is just starting with the example amount of $10,000. So that's kind of goes back into why I made the book, because I know I just kind of went through a lot of things and you're like, yeah, that probably makes sense, but kind of, how do you get started? Like, where do you start, right? What do you invest in to make sure that you're getting the returns of the market, right? What should you do before? How do you manage it? Should you pay somebody to do it? Can you do it yourself? How much money do you need to get started? So things like that, all of that is in the book. And I kind of break it down step by step and make it as simple as possible so you can follow along and you can start from opening an account, making your first purchase, and then giving you a plan that leads you to retirement. So that's all I have to share. I know that was a little rocky, but I'll open it up to questions if anyone has any, or I can kind of keep going over, what's in the book and some other things that are essential to get started investing.
Yeah, I would love for you to continue going over some of the basic principles in the book. And I have some questions I'm going to ask you before we open it up to the audience. But you all definitely feel free to put your questions in the chat. Jordan is also going to put in the chat the link to his book and how you can contact him as well on socials or however he feels comfortable being contacted after this. But for those who are new to the call, I forgot to say earlier, we loved for it to be very interactive. So if you hear something you like, send us a reaction. Put your questions in the chat. We definitely want to hear from you guys. This is an interactive webinar. So if there's something you don't understand, because I know I have a lot of my own personal questions I'm going to be asking him, because this is something that just is kind of Mandarin and foreign for me. But definitely, we will be addressing you all's questions. So don't be afraid to ask any questions. Just don't come off mute yet until the official Q&A segment. So Jordan, yes, you can definitely continue with some of the highlighted principles of your book. But I first want to do our first raffle. We always do a raffle for the first person to enter the webinar, and that was Miss Cicely Drummer. So I'm going to be sending you a gift card before the end of this week via text message or email, whichever you prefer. Just let me know. Okay, Jordan, it's back to you.
Okay, so first thing, the most important thing when starting to invest is, first of all, understanding when you're investing, what you're investing in. So buying a share or buying stock is ownership in a company. So as we know, the prices of these, the cost of living is continuing to rise. Prices of everything are continuing to go up. These companies, these big corporations, they're making more money than ever, and they're not increasing the employees' wages. So their profit margins are growing higher and higher. That's why the economy continues to rise. So if you're a consumer, you're spending with these companies, but if you don't own any of these companies, you don't reap none of the benefits that come with them. So when they keep expanding, keep making new products, people keep spending money with them, you're not benefiting from them. So first of all, I think the most important thing is to understand what you're doing when you're in the stock market, understanding what you're investing in, right? And then the second thing is understanding that you don't have to pick an individual company. So let's say we talk about companies all the time, but let's talk about Apple. Apple just had a CEO step down. Let's say they get another CEO and that CEO decides to stop making iPhones. What will happen to that stock? It'll go way down, right? Or let's say somebody comes out with something that's better than the iPhone. That happens all the time. Think Blockbuster and Netflix. Things like that happen all the time. So if you're investing for the long term, you don't want all your eggs in one basket. And you don't have to do that because now they have index funds and exchange traded funds that trade just like stocks um, where you can invest in a group of companies. So one thing I really love are ETFs, they're exchange traded funds. So they track the market. Yes, can you talk about the time? Yes, I will get to that. They track the entire market. So when I say the market's up 77%, there's funds out there that tracks the entire S&P 500. So when you're in that fund and the market is up 77%, you're getting close to that 77% in your portfolio versus choosing one company and then you're at the mercy of that one company. So you're well diversified when you're investing in ETFs or index funds or even mutual funds that you can do, with the broker. Uh, Let me pull up the chat so I
But
can.
before we get to the audience questions, I have my first question from what you just said. Can
Yes.
you explain, can you break down, like in plain English, the ETF versus mutual? I don't even remember what you said, but can you explain those a little bit more in detail to understand the differences?
So yes, absolutely. So I'll start with an ETF. Well, actually, I'll start with a mutual fund. So mutual funds, so if you have a retirement account or 401k and you see that it's growing year after year, it's probably in a mutual fund. A mutual fund is something that you get through a broker agent or a financial advisor. Um, they put your money into a fund. So same concept with group of stocks, and they are active. They have analysts. So Invesco, Vanguard, Fidelity, all these companies, they have the analysts and they're kind of looking at the charts, looking at the charts, looking at companies, forecasting what they'll do in the future. And they're actively managing your portfolio. So you're paying a sales charge, you're paying an expense ratio for them to actively manage it. The ETF is similarly managed. However, it's not actively managed, it's passively managed. So once they set the group of stocks that they're going to invest in or the group of companies, they kind of let it sit there for the whole year. So for example, the S&P 500, if you got an S&P 500 index, S&P 500 ETF, they have their allocation of what they're going to allocate. So they might say, we're going to put 8% in NVIDIA, 8% in Google, 8% in Apple, right? And they're just going to let it sit there. And then after a year, they'll go back and then kind of make adjustments on how they see fit or how those companies have done. In a mutual fund, they're a bit more active. So if they see, okay, Apple isn't doing as well, so let's rotate. Let's take that 8% in Apple. Let's put, let's make NVIDIA 10%. NVIDIA is going to do well in the future, or we think Google is going to do a little bit better than Apple in the future. So let's put more into that and less into Apple. So they're actively managing it, and that comes with higher expense fees, and they kind of have a fund objective. So anytime you get into a mutual fund, they usually send you a prospectus that kind of tells you, okay, this is the objective of the fund. The objective can be income, the objective can be growth, the objective can be protection of your money. So if you're a bit older, I would recommend mutual funds because you don't want to just be in the market completely with, you want to have some downside protection. So that's where mutual funds kind of come in. So if you're over the age of, I would say if you age of 40, 45, I would start looking at mutual funds and having something that's actively managed. But if you don't have a lot of money and you're young, in your 20s, 30s, I would be in ETFs because they're passively managed. And like I showed you all in the on one of the slides, the market over time has always gone higher, even with the pullbacks. I showed you the last 30 years. I know real estate agents, 2008 was a rough time, right? It was in the slide. It was a small blip. 2020 was a small dip. 2001, if people are old enough to remember that, it was a small dip. We're way higher than that, right? So there will be pullbacks at times, but if you're in the market's going to keep going higher. So if you're young, you don't really have too much to worry about as far as downside protection because you have time to recover. And as you get older and closer to that retirement age, that's when you want to start protecting your money. So I would advise for younger people, it's a lot cheaper, a lot less expense ratios, a lot less in expenses and sales charges if you were in an ETF. That's something you can manage on your own, like on your phone with the brokerage app. And if you are a bit older, I would start looking to get into like mutual funds with the agent or broker. And I'm a broker agent, and I can help you with something like that if you wanted to do that as well. So I would
Yes.
say that's
Help
kind of the
me.
difference
Help
between the
me.
two.
Help. I'm raising my hand actually officially. So let's get into some of these questions in the chat. The first one said, what age range is your book geared toward?
So it's good for all ages. It's kind of geared towards people that kind of just have no experience in the market. So if you have no amount of money, you know nothing about the stock market, this book is for you because it breaks it down step by step how to get started, and it gives you some options of what you can invest in. So I would say it's tailored to probably younger people that don't make a lot of money right now, that can manage their portfolios on their own until they start making the high income and really have to protect that money. So I would say it's for all ages. All ages have benefit from it. But when I wrote the book, I kind of had in mind the beginner that was probably just getting started, the young adult.
Awesome. And then the next question asks, can you talk about the types of accounts you can invest in? I have a
So,
401k for work.
so yes, so there are different types of accounts. There are different types of accounts that I mentioned in the book as well. So one that a lot of people notice or have is the 401k. The 401k is through your employer. So the way the 401k is structured is based on how you pay taxes. So when you contribute to a 401k, you're not taxed on that money right away. It's called tax deferred. So they take money from your paycheck. You never see it. It never hits your bank account. They put it towards in a mutual fund more than likely, and it grows tax deferred. And then at tax time, whatever your salary is, let's say you make $100,000 a year and you put 10% into your 401k. When it comes to tax time, you say, hey, I didn't make $100,000 this year. I only made 90K because I contributed 10% to my 401k. So then you get taxed in the 90, you get taxed as if you made $90,000. And that's kind of where the refunds come in at and things like that. Also, 401k, there's the 403b. If you are a government worker, same concept. Government worker, work for the city, work for the state, you'll probably have a 403b plan. And if you're in the military, you will have a TSP plan. And they'll all be in that same type of structure where it's gross tax deferred. And then the second account, which most people don't do this, and this is literally free money, is called the Roth IRA. The Roth IRA is not quite like the 401k, because if anyone has a 401k, they've always been told, or 403b, 403b, any of those tax deferred plans, if you go in and withdraw that money, you have to pay a penalty on it because you never paid taxes on it. The Roth IRA is a bit different. The Roth IRA, you pay taxes on it. So this is not money from your employer. This is money from your paycheck. So this is something you have to open on your own on the outside. So this is money that you've already paid taxes on. So if you made that $100,000, when you go to tax time, you're gonna say, hey, I made $100,000, but you contributed some of that money to a Roth IRA. You won't get it, it doesn't reduce your taxable income, but this money grows tax free. So if you are young or 40, if you have 20, 30 years for your money to grow tax free, and I just showed you the numbers. If the market's up 70%, all of that money at the age of 59 and a half, you don't pay taxes on it at all. So you have tax deferred and tax free. And another good thing about the Roth IRA is, since you already paid taxes on it, if there was ever an emergency where you had to go in and take money out, you can take out your contributions because you paid taxes on them. You'll only be penalized if you touch the gains. So if I contributed $100 and my $100 grew to $107, I could go in and take out that $100 with no penalty. I couldn't go in and take out that extra seven that grew while it was in the Roth IRA. I'll be penalized on that. So that's an account that I know a lot of people probably hear about all the time, but a lot of people do not take advantage of it. And it's so good that they actually give you the contribution limit. So the contribution limit, if you're under 50, is 7,500, and I think they have $1,000 catch up if you are over 50. It should be, I believe it's 85 or 8,600. I have to fact check that, but that money grows tax free, and not enough people take advantage of that account.
I love that. I've heard about a Roth IRA and I still have not made that next step. So I heard somebody else in the chat said they want to talk to you too, and they have a Charles Schwab. Which brokerage are you with?
So I am currently with Fidelity. Charles Schwab is a good one. Vanguard is a good one. I like to compare the brokerages, kind of like bank accounts, right? The bank you bank with doesn't really matter. It's more about the account and the account structure. It's just about preference of interface when it comes to managing it on your own. So I use Fidelity personally, but Charles Schwab, actually, I think I have a Charles Schwab account too. They're both pretty good. They're both user friendly. That's what I would look for. Something that's user friendly. And I think Charles Schwab is better at, if you need help, you can actually call somebody and get somebody on the phone to talk to them for help. I think that's one of the advantages of Charles Schwab over maybe like the Fidelities and the Vanguards, is that they have more people that will help talk to you. But yeah, the brokerage doesn't matter. I know Robinhood has made a resurgence because a lot of people are traders. They like using Robinhood because of the ease of interface as well. So it just depends on whatever fits you. All the same stocks you can be bought in all of the different accounts.
You actually just hit on one of my other questions too. Like, I hear about investing, I hear about trading. Is there a difference, or are those terms used? Can those terms be used the same? What is the
So trading. So I'll get into trading. Trading has become a popular thing, but trading is basically looking at the charts and trading the daily swings of the market. So I go back to that slide again. I might need to pull it up, but I go back to that slide again where the market continuously goes up, but it doesn't go up in a straight line. It goes up and down, up and down. So on the daily basis, up and down. So basically, trading is when you're over leveraged and you're kind of betting on the swing of the market if it's going to be up or down. So high risk, high reward, takes a lot of skill. Investing takes no skill at all. Trading
okay?
takes a lot of skill. It takes a lot of time. And I say it takes a lot of capital. People don't understand, when you're trading like that and you rely on that income, you can't make sound decisions. So you don't know when to sell, when to hold, when to, let it keep going because you need that
Mm-hmm.
money. So trading has its place, but I wouldn't recommend that for everyone. Investing is something I recommend for everyone. That's betting, that's understanding the company that you're investing in. So if you're in an ETF, that's betting on the US economy. If you're in an S&P 500 ETF, that's betting on the NASDAQ, that's betting on the 100 top tech companies in the world. If you're in that, in an ETF that tracks that index, that's it. If you are in a single stock, so that's looking at Google, looking at the fundamentals of that company and saying that I like this company. So I'd like to talk about, when I talk about investing, I like to say, think about if your friend asks you for a loan and they're starting a business. They say, and you'll have equity in their business. You're going to want to hear them out, right? And what they're going to do, because you want to say, is this worth actually putting my money into? That's what investing is. It's taking part ownership in a company that you're not running. Trading is kind of like, it's a form of betting. It's a form of statistics. It's kind of betting on what has happened in the past and will it happen again.
Got you. Got you. Very good breakdown. Somebody in the chat said, can you provide mountain chart?
Uh, Say that again.
Can
Can
you
you
provide
provide?
mountain chart? Mercedes, you might have to come off mute to ask your question because I'm not sure what that means either.
Okay, I'm sorry. I I heard someone say something about mountain chart to get like a history back like years ago on how performance is on a particular stock, like the I think it's called American Fund something stock that kind of invests in a lot of things. Just like you were talking about a mutual fund, but it's called American something
American
fund.
Franchise Fund. I think I've heard of that one before. Yep.
And but are mountain charts provided for each stock that you invest in, or just for that particular stock that invests in a lot of other companies?
I think so. I think what you may be referring to is a prospectus, and that kind of shows you the history of the performance of the fund. I
Mm-hmm.
think in the prospectus, it shows the overall history of the fund because with mutual funds, they're actively managed. So one company may be in there 1 year, 5 years later, that company may no longer be in the fund anymore because they're actively managing it. So I don't think they show each fund. I don't think they show the performance of each company individually, but they will show you the percentage the percentage of how much money you're putting into each fund. So if the fund is putting 8% into Nvidia, it'll tell you 8% is going to Nvidia, 5% is going to Alphabet or Google, kind of like that. And if they rearrange them, they will show that. But before you buy like an individual stock, it will show you the performance of that company and it'll show you the fundamentals. Google Finance is good with that. Yahoo Finance is good with that. Also, like Robinhood, Charles Schwab, Fidelity, they kind of show you the performance of the stocks before you buy. You can kind of look at what this called is quotes and like kind of like a small like market analysis of what the fund has been doing or what the company has been doing in the past.
Does that answer your question?
Yeah, does that answer your question?
Yeah.
Okay, great. So my question for you, Jordan, is just this is my first day, and I'm not even just speaking hypothetically. This is my first day, you know, learning about stocks, and as a realtor, I am well versed in real estate investing, but it still feels like this is just so different. And so I would just ask, as a complete beginner, what is the first step to getting into the stock market? I heard you say investing versus trading. I heard you mention the EFT, I believe, earlier. Yes,
Yeah.
I agree. Somebody says it's very daunting. Yes, that's how I feel like it feels. Even though you said it's not scary in your book, it feels scary.
Yeah.
So, what is the beginner's very first step? What does the initial investment look like? If you don't have 10,000, can you do 50? Can you do 25?
Well, I'll answer the last question first. You can start with as little as $5. So I always say starting with a little over time, it builds to a lot. The other question is if I was first starting, and this is kind of what I go over in the book, kind of like exactly like where to start. First thing you need, and kind of the same thing with real estate investing, you need a budget. You need to know where your money is going. So then you can figure out how much can you realistically afford to invest. So first thing you need is a budget. Second thing you need is an emergency fund because, like I said, for your money to grow in the stock market, you can't keep going in, pulling it out, because the market isn't linear. It goes up and down, up and down. So you need to give it time to grow. So first two things you would need is an emergency, a budget, know where your money is going. Second thing you need is an emergency fund. The third thing you need to do, and this is really important, is you need to pay off high interest debt because the stock market gives you between 8 and 10% a year. That's historically, that's what it gives you. So we're kind of playing the numbers here. So we can't expect to get any higher than that. I know I showed that over the last 5 years it's up 70%, but we can't realistically expect that. Historically, the market's giving us between 8 and 10%. So we got a lot of credit card interest and it's accruing at 12, 15, 16%. It's erasing all your gains. So you're kind of working backwards. So next we have to pay off our high interest debt. Now, low interest debt like student loans, maybe you got a small car loan, something like that, you can start investing and actually investing. Once your money grows, you can take out the gains and pay off the debt if it's low interest. So if it's 2, 3, 4%, you can start investing with that. But if you have high interest debt, you first need to pay that off. And then after you do that, then I would get into investing. And that's when I would open an account. I would figure out, okay, what do I want to invest in? What are my goals? Think about, what your goals are. What type of account should you use? Should you do it in your 401k? Does that make sense? I think that makes sense for high income earners that want to reduce their taxable income is to put more money in their 401k. I think for a lot of young people, I think putting it into a Roth IRA because you're not at your income potential yet. So it's better to pay the taxes now and then let that money grow tax free. If you think, hey, I might need this money before I retire, well, you can open just a regular brokerage account and pay taxes on it as and just pay capital gains taxes at the end of the year when you sell your stocks. So I would say figure out what you want to invest in. What are your goals? And then once you do that, then I would come up with a strategy. There's many strategies out there. The one that I like the most is dollar cost averaging. So that's just a fixed amount every week, fixed amount every month. And that way, if the market goes down, you're just getting more shares at a discount because that's all it is because you're investing for the long term.
Can you repeat what that source was? Is that a website?
Oh, no, I said a dollar cost averaging. So that's basically just putting a fixed amount of money into a stock over a long
Okay.
period of time. So that's not dumping $10,000 if that's all you have in a fund all at once. That's doing it in regular intervals. So you're getting the best average cost versus, what if you put $10,000 in and you buy it when the stock is overvalued and then it drops down a little. Doesn't mean it's not a good company. It was just overvalued at the time. That's kind of like if you were at the store looking for shoes. The shoes just came out, so they're kind of overvalued. So you bought, you bought 10 pairs of the same shoe and then they kind of went down and now you feel like you lost out versus buying, one pair then, one pair the next week. If they go down and they're undervalued, you might, buy more. So that doesn't mean it's a bad shoe just because it went down in value. It could have just been overvalued at the time. So I would say dollar cost averaging eliminates the need to kind of time the market and, when's the best time to start investing. Just doing it in regular intervals, and over time, you'll realize you'll get a really good average price.
We have another question, but I want to ask this so I don't forget. So, when it comes to hiring a broker like yourself, what does that look like? Is that like a kind of like when you hire your CPA? There's a fee, and then they go in and they do everything for you. Like, what exactly is the process for hiring a broker?
So for brokers, basically they have access to a different set of funds, so they can find a fund that best fits your needs, and you pay a initial sales charge. So based on the fund, you pay the initial sales charge, and they kind of tell you, okay, on the front end, this will be like I think I see someone say Class A. So like Class A shares, you pay a fee on the front end, and then that's all you pay, and then the money grows from there. And then there's expense ratios cooked into the price that you're paying for the fund. Same thing with ETFs. ETFs don't have the sales charge. That's why I tell people, and the expense ratios are much lower because the analysts that are managing the fund are doing a lot less. So the expense ratios are a lot less. But I think it's worth the expense ratios if you're a bit older and you have an objective in mind and you want to have some type of protection and an income, kind of like if I would say if you're a bit older, I would opt for the higher fees because you know that it's actively managed and that's their job is to look at your fund all day.
Gotcha. Gotcha. And how long do you recommend? I heard you say like, you know, you don't need to just be pulling it out all the time. How long do you recommend your first investment should sit? Just based on, the averages and the data that you have before you start to try to withdraw.
So I think that depends on your objective before you start investing. So let's say you like, okay, I want to buy a house in 5 years. If you want to buy a house in 5 years, you don't want to be, and maybe you don't want to be fully invested into the entire economy. You want to find stocks that pay dividends. So they might not grow at the rate of the economy, but they pay a fixed payout every month or every quarter. So it really depends on your objective, and then you find funds or you find ETFs that fit that objective. So I think that that's a question that it varies from person to person.
Okay, great. We have some questions in the chat. What is the lowest amount you've seen someone invest in just to determine how much to save to start to invest for your first investment?
So actually, I'm gonna plug in my social media right here. But on TikTok and Instagram, I actually started a challenge where I just invest $20 into the same ETF every single week, and I've been doing it for I think this is probably like the 29th or 30th week. It's to about 600,
Hmm.
$700 now. $20. That's all I did. $20 a week. You can start with as little as $5 a week. So let's say a stock costs $100. The stock costs $100. You can buy what's called fractional shares. So you don't even have to buy a full share. You can buy a
Hmm.
fraction share with as little as $5. So I say start with what you can afford. So if you can only afford $5 a week, that's $20 a month. You look 12 months from now, that's way more money that you'll have than if you had waited, right? And like I said, it doesn't go up linear. It doesn't go up linear. There was a time where I did the $20 a week challenge and the market was down. I was down 2%. Then I was down, I think I was down like 4%. Now I think I'm up 7 or 8%. Actually, let me check right now because it's Tuesday. That's usually when I
That's
do.
what I was going to ask next. Like, is there an app? Like, how are you checking this? Is there like a certain app, or it
So it's
depends on
on
which
the
stock you
so
invest in?
it's on the brokerage app. So if you have
Okay.
Fidelity, if you have Fidelity, Charles Schwab. When you open the account, it'll tell you what the stock is doing today. It'll tell you what it's been doing since you bought it, and it'll kind of tell you your rate
Hmm.
of return and how much money you're up.
Gotcha. Gotcha. Okay.
So yeah, actually, right now I've been doing it for I think 29, 30 weeks. It's up 9% in 30 weeks. And that's with $20. So imagine if I did $100 a week. I could, I do a bit more in another account, but just for the sake of the challenge, I started with $20 and I don't even miss the $20. And some weeks I've forgotten to make a video, make an update, but I've never forgotten to actually put the $20 into the fund that I want because it's automated. So just like you can set it up just like a bill to where you don't have to do it because our motivation fades. Once we get off this call, you go to sleep, you like, yeah, I want to invest. And
Yep.
then the next day you're like,
Yep.
I'll
Yep.
put it off. But once you set it up, you don't have to stay motivated
That sound
because
like me.
yeah, you don't have to stay motivated.
Okay.
Exactly. $20 is a trip to Chick-fil-A. $20 is one less drink.
Right.
It's $20. Yeah. So any amount is whatever you can afford. I say start with that, and then you'll get comfortable with it. And once you get comfortable with it, and then over a long period of time, you start adding more money. You get raises, you get more money, you get a bonus. So now, anytime I get any extra money, I'm trying to like dump in, put more money in, because I like
Right.
seeing it grow.
Right. Well, Jordan, can you go ahead and put your contact information in the chat as well as a link to purchase your book? I do want to go ahead. We are at the Q&A segment, so I want to go ahead and open it up for questions at this time. You all can come off mute if you would like to. If not, you can continue to put your questions in the chat. I saw Miss Cicely Drummer, your hand was up, so I will let you ask first. Anybody else, you can just kind of popcorn in as you guys hear him wrapping up the answers to the questions.
Okay, thank you for the opportunity. I have one comment which I hope will motivate some people on here, and then I have actually two quick questions. So my one comment is true story. When I was 23 and starting work, I went to Edward Jones Investments and had like a little consultation thing with them. And the guy that gave me this whole plan, and he wanted me to invest $250 a month. And I thought he was crazy. I was like, that is so much money. There is no way I do not have $250 a month. But I say this to say that I just didn't want to have $250 a month because every other week when I got paid, I went and I bought a new suit because I felt like I needed to treat myself to something because I work hard, et cetera, et
Mhm.
cetera. And I just want to say it's a decision that I can be honest and say I regret. And had I, invested that $250 a month instead of like I needed, how many suits does one person need, right? That I had, um, uh, I would be a multimillionaire many times over had I, followed that
Yeah.
advice. But it was a mindset, and I wasn't ready. And I
Yeah, we
say
have to
that this,
prioritize.
yeah, I wasn't ready and willing to prioritize it at that age. And so that's my first question is I'm struggling with that with my children because I'm Gen X and they're Gen Z. Every slide that you had up here, I have shown them. I've shown them the rule of 72, how the index over the S&P over the 30 years, all of that. We've opened Roth IRA accounts. If the Hawks win the championship, my son will say, "Oh, I'm gonna go and buy a playoff ticket." But his mind never I'm struggling with finding that motivation for them to make that same commitment to investing. He'll do that and he pays for some PlayStation thing. It's $100 a month. And these are college students, working college students, but you find $100 a month for PlayStation. They go to Starbucks, they go to Chick-fil-A, but they are not consciously thinking about setting aside automatic money um, for investing. And I'm looking for any recommendations or suggestions of something that I may have overlooked to help motivate these young kids.
Yeah, I have a hard time explaining that to young people as well. Not only with investing, but also, and this is a whole nother story, but life insurance as well. Like
I
starting
was gonna
early,
say that.
time in the market is your friend. And
Yeah.
our parents, our parents, the generations before us, they had pensions, they got Social Security. We don't know if that stuff is going to be there. They've already taken away pensions. So if
Right.
you're not investing, you're gonna be working to the day you die.
Right.
So that's what I preach. Like, do you want to be working until the day you die? So now that I'm 26, a lot of my friends are around that age now. They've been working for 3 or 4 years. They're like, dang, I got to do this for 40 years, and then I might be able to retire. And then it's like,
Right.
well, 40 years from now, you're gonna be doing the same exact thing. And I talk to people when you go and just look at your surroundings. We live in an area where it's not a lot of financial affluency. And when we go into grocery stores, we see old people there working, and that's probably because they didn't have proper retirement. Like we see things like we see signs around us all the time, and we don't realize kind of how that happened. I know we all been to a grocery store saying like, "Why is this old lady still working there?" 9 times out of 10, it's not by choice. It's because they don't have enough money saved up. So I tell people all the time, like time in the market, and then you could tell them this. I love to put math to it. So if they put, I don't know how old they are, but let's say they max out their Roth IRA, and let's say they're 21. They're
They're
21,
20, yeah, 21.
21. They started investing today, and they just treated it like a bill. So every month they have to do this. Let's say they put 200, let's say they put $200, and we can do the math. I'll get a calculator out. Let's say we did $200 a month for for 12 months. That's $2,400. And we did $2,400 by the time they reach the age of 65 or even 59 and a half. So if they do that, and I'm trying to do the math in my head, but 59 minus 21, because that's usually we can. So if they do that for 38 years, 2,400, and it grows at 10% for 38 years.
But I've done that. I've shown them that. I've sat down and done all of that. And they still they gonna go buy those playoff tickets and not put a
Well,
deposit in the Roth IRA. It's driving me crazy.
well,
What
we
I
got
about
to
do think
show. I feel like we have to show them you can do both. You can do both. So they want the playoff tickets. They need to set a separate fund for that. So I don't know. I think my girlfriend, she was on here earlier, but everything we do, that's in a separate fund. Cause I know when I'm with her, I'm like, this is how much money I got. I don't mix the two because I know if I let her convince me I've been to spend all my money, I won't have nothing to invest.
Right. Right.
So
Right.
I keep them separated. I have a non-negotiable. I treat it just like a bill. I pay my just like I pay my mortgage every month. I'm not gonna let that lapse because I'm not gonna have a place to stay. I got that
Right. That's
automated. I got my
good.
investments automated too. So it's like I don't even um
They have a non-negotiable too. It's the PlayStation. Every
I think the
month.
yeah.
automation is
It's the
good, but
membership to the PlayStation account.
I
So
think
just like they
I
have the
think
membership to the PlayStation account, they need to have a membership to their Roth IRA. They need to have a membership to investing
I
because
get it.
it's not
I
a
get I get it. I was just looking
yeah.
for, just throwing that out there. That is for me as a parent, it's a struggle, it's disheartening. Me growing up, I didn't know what I didn't know. My parents didn't know, investing wasn't like it is now. They didn't have any knowledge, and now they have a parent who has the knowledge and is sharing it with them, but they're not acting on it. And
yeah.
I struggle with that. But I'm going to give you the information, but I'm not going to put the money in the account for you at the end
Well,
of the
maybe you can buy his, maybe you can send them his book and maybe they can hear it from a different, because I know I was gonna say a lot of times as a child, you
day.
hear it differently when it's not coming from your
From your
parent.
parent.
And I
Absolutely.
think also, I know, for me, a lot of the seeds that were planted didn't make sense until I needed it.
Mm-hmm.
And hopefully it won't take that long, but sometimes like it's worth it to continue to say it over and over because eventually your child hears it, whether they hear it when you want them to or when they are ready and mature enough to hear it. But just I would say keep pouring that into them because eventually it's gonna all click.
It's gonna be. Okay, I
Yeah.
don't want to monopolize your time. Last thing. You mentioned Fidelity and Vanguard. Are there any minority owned investment um companies that you um can put out there?
Brokerage firms.
Yes.
Not
Minority.
not that I know of. There's so many regulations to get into the field. I don't think there. I don't know of any. And if they are, I would welcome someone to put it in the chat. I don't.
Let's start a business. I'm ready. I mean, I'm not ready, but that's something to keep in mind.
Yeah, I definitely like to promote supporting minority owned companies.
Same
But
here.
yeah. Okay,
Um,
thank you.
for you guys who are still hanging on, Jordan did put the link to his book and to set an appointment with I, which I already made in the chat. So please take advantage of those resources. If you're not quite ready to make an appointment yet, at least check out the book. Very affordable, very easy to read. Like he said, he broke it down into elementary language so that you can kind of do it at your own pace. So highly recommend you get the book or schedule an appointment to learn more. But if anybody else wants to come off mute and ask a question, you absolutely can do so at this time. Mercedes also mentions the IULs. I have an IUL as well. So if you guys are not familiar with the IUL, Jordan, do you mind kind of going over what that is?
Oh yeah. So it's a cash value policy. I believe that kind of track. It kind of I believe it kind of tracks the index, so it gives you it does grow tax free. What I would say about that, I would say there are a lot of hidden fees in there as well. So I would really look at the policy and make sure that it's structured correctly. Um, I would really look into how it's structured because I'm really not a fan of mixing your insurance with investments because insurance is if you die too soon and your investments is if you live too long. And when you start combining the two, you end up paying a lot of fees, a lot of hidden fees. So I would definitely look into how it's structured, but it can be another way. It is another way to take advantage of the market. But yeah, that's what I would say about that. I feel like that's a whole another conversation.
All right. Any other questions? Any other questions? Anybody have any other questions for Jordan at this time? All right. Well, we're going to do one more raffle to wrap it up. Can y'all send some fire in the chat, some reactions? Send him some love. If you guys learned anything tonight, can y'all go ahead and interact with us. Give him some energy for his time today. Truly, truly appreciate you for being on this call and being willing to share your wealth of knowledge. Truly say thank you. And I'm going to go ahead and let you ask the last. Got some fire going in the chat, some celebrations. I see some clapping. So people really enjoyed your presentation. And can you go ahead and ask a final question? And the first person to answer correctly in the chat, not off mute, you have to answer in the chat, will get the second raffle prize sent to their phone or email.
Okay, you said a question, so I have to kind of think of one.
Yes, based on something that you talked about.
I talked about. I guess the main thing I talked about is let's say the rule of 72. So if you have a 4% interest rate, how long would it take your money to double? And I'll give you a hint. I don't think it'll be a whole number. It'll be a year and some it'll be a year and some months. It won't be a whole number.
He gave y'all a math question.
I'm doing the math myself.
I remember you gave the formula at the beginning. So let's see who gets it right. We have a response in the chat. I'm not sure if that one is correct.
Yeah, I don't think that one is right.
And can you repeat your question one more time?
I was just off the top. Yeah, I was going to ask you that. Can you ask it one more time? The rule of 72, I know how to calculate it. You said how many years and what?
I said, how long would it take your money to double if your rate of return is 4%? Based on the rule of 72. And actually, I just calculated it is a whole number.
All right, y'all. Put your answers in the chat. The first person to answer correctly will get the second raffle prize of the evening. They might need another hint because they are not saying anything.
Okay, yeah, she got it. That's
okay.
it. Yep.
So can you repeat the formula for everybody who they might have missed the beginning? I know a few people aren't here at the beginning either.
So the rule of 72 is you take 72 and divide it by your rate of return or your interest rate. So this works with interest, and this works also with when you have debt as well, how long it takes your debt to double. So you divide your interest rate, you take 72 and divide it by your interest rate. So if you're getting a 4% return, you'll divide 72 divided by 4, and it'll give you 18. It'll take 18 years for your money to double.
I like that. Well, I learned a lot. I want to just say thank you so much again. I cannot wait to connect. I did make my appointment. I hope you guys made your appointment as well to continue this conversation. Jordan, can you let us know where we can find you on socials? I heard you say you had a challenge that you were doing for the $20 a week. I'm sure people want to follow you and participate in that as well.
So TikTok and Instagram is 40s Financials. So I'll type it in the chat. It's FORDEES Financials.
All right. His Instagram is in the chat. Follow him on Instagram. You can set an appointment. You can buy his book. Just so proud of this young man, 26 years old, investing, building generational wealth. And that's what I'm passionate about. If there's anybody else you guys want to invite or to recommend that we have conversations, I'm very, very open to that. It does not necessarily have to be real estate or investing related, but my goal this year is just to make sure that we're having conversations, like Ms. Cicely was talking about, that we don't normally have, especially in the African-American community. So anything that you guys have heard of or you want to learn more about, please let me know. You can follow me on Instagram at Regal Realty Group ATL, and you can send me a DM or you can text me a message sharing your thoughts on our next topic for June, July, and the rest of the year. So thanks again, Jordan. We are right at 6:59. Thank you, everyone who participated. I think we have a hand raised. 1 second. Mommy, it's my mom. Mommy, is your hand raised on purpose? I don't think it is, but okay, no, it wasn't. All right. Well, thank y'all so much. And you all have a great evening. You guys will be receiving the recording sent to your emails within the next few days. So please check your emails. I apologize for those who did not receive the link tonight. I'm not sure what happened. There was supposed to be 2 emails that went out today and a text that went out today with the link information. So be sure to check your email for the recording in case you guys want to go back and watch it again. Thanks for your time, Jordan. And y'all have a great night.
All right. Thank you for having me.
Y'all are so welcome. Thank you.
Thank you.
Bye, everybody.
Thank you. Bye-bye.